Okay. You know how you see those headlines about people making a killing in the options market?
Yeah.
Like turning a little bit of cash into a ton of money?
Yeah, it's super tempting, right?
It is. Who wouldn't want that?
Mm.
But honestly, for most of us, options trading is less like striking gold and more like just, well, watching your money disappear.
Yeah.
So we're doing a deep dive today to figure out why.
It's interesting because options trading is often made to sound so easy, like anyone can do it. But the reality is, you're actually 3 times more likely to lose money trading options than to make money.
3 times. Wow.
Yeah, it's a pretty big difference.
That's like, what, walking into a casino where most of the games are rigged against you from the start?
It's a pretty accurate comparison. Today, we're going to really dig into why that is. We'll look at how options actually work, those hidden costs that kind of eat away at your profits, and even the psychology behind it all, because that can really trip people up.
I'm ready to get into it. By the end of this, we'll all know whether options trading is something we should even think about, or if it's better to leave it to the Wall Street experts.
Right.
But before we go any further, let's take a step back. For someone who's never even thought about options before, can you explain what they are?
Okay, imagine you're at a concert and you see that limited edition poster, the one you absolutely have to have.
Oh yeah, I know the feeling. Happens to me at every show.
All right. But maybe you're not sure if you can afford it right this second. An option is kind of like putting down a small deposit to reserve that poster. It gives you the option to buy it later at a set price before a certain date.
Got it.
That set price is called the strike price, by the way.
Okay.
Now, if that poster suddenly becomes super valuable, like everyone wants it,
Right.
you can buy it at that lower reserve price and then resell it for a profit. But if the poster kind of flops and nobody cares about it, you just walk away. You only lose that small deposit.
So it's like a buy it later ticket, but for stocks.
Exactly. And you can also buy put options, which let you sell a stock at a certain price if you think it's going to go down.
Okay, so you're kind of betting on whether the stock will go up or down, but with this option contract acting as a safety net or a way to potentially get bigger gains, is that right?
Exactly. And that's where things get interesting, because options can be used in 2 main ways. Large institutions, like those big hedge funds, often use options for risk management. They call it hedging, which is basically like buying insurance for their investments.
So options are like a safety net for the big players.
Pretty much. But for individual investors, people like you and me, options are often used for speculation, trying to make a quick profit from short-term price swings.
And that's where things can go wrong.
Often, yeah. And one of the biggest reasons individual investors lose money with options is because of something called the bid-ask spread.
Oh, here comes the financial jargon. Can we break that down a bit?
Of course. Imagine you're at a farmer's market and you see a basket of apples you want. The farmer is asking $10 for it. But you think, I'd only pay $8 for that $2 difference. That's kind of like the bid-ask spread.
So the bid is what the buyer wants to pay, and the ask is what the seller wants to get.
Exactly. And the difference between them, that spread, is essentially a hidden cost that eats into your profits.
So the wider the spread, the worse it is for the buyer.
Right. And you know what? Studies show that retail investors, the average person, they often get hit with much wider bid-ask spreads compared to those big institutions. It's like paying a premium just because you aren't part of the Wall Street Club.
Hold on, so we're already at a disadvantage before we even make a trade? That's not exactly encouraging.
Yeah, it's something a lot of people don't realize.
And that's on top of any commissions the brokerage might charge, right?
Exactly. It all adds up and makes it harder to come out ahead.
This is starting to sound like a rigged game. Can the average person even win at options trading?
It's possible, but it's not statistically likely. Plus, there's another thing to consider. The information gap.
A what gap?
The information gap. Those institutional investors have access to tons of data, fancy algorithms, real-time market info, things most individual investors just don't have.
So it's like playing poker, but the other person can see your cards.
That's a great way to put it. They have a much clearer picture of what's going on, and they can use that to their advantage.
Okay, this is painting a pretty bleak picture. Hidden costs, information gaps, statistically more likely to lose than win.
But what about those stories we see, about regular people becoming millionaires from options trading? Are those all just made up?
Those stories are real, but they're usually outliers. The problem is they get so much attention, the media hypes them up, social media blows them out of proportion, and it creates this illusion that anyone can get rich quick with options.
So more like winning the lottery than a real investment strategy.
Pretty much. And that brings us to another big thing. The psychology of options trading, how it can really mess with people's heads. Okay, let's dive into the mind games. What are we talking about here?
Well, there's this whole culture around options trading that's become very gamified. You see ads with all the flashy graphics, promises of huge returns, testimonials from these so-called gurus who claim they've figured it all out.
Yeah, I see those everywhere. It's tempting, but I always wonder how much of it is real.
It's mostly just clever marketing, playing on that human desire for fast, easy money. But this marketing, it creates what we call a casino effect.
Okay.
People start thinking of options trading like gambling, like it's all chance instead of a disciplined strategy.
So they're not focusing on research or long-term goals, they're just chasing those wins, right?
Exactly. And the more they trade, the more they're exposed to those hidden costs we talked about, the bid-ask spread, commissions. It's a recipe for disaster.
So it's not just the market that's working against them, it's also their own brain.
Exactly. Our brains are wired to seek rewards, avoid losses, and it can lead us to make impulsive choices, especially with money.
So we're fighting a battle on two fronts, basically. The market and our own emotions.
Yeah. Which is why it's so important to understand the psychology of it all before even thinking about getting into options trading. So we've been talking about how those flashy ads and the get-rich-quick stories can really mess with our emotions.
It makes it hard to see the reality of options trading.
It does. But if it's so hard to actually win, why do people keep coming back to it?
Right. That's what I don't get.
It's complicated. But a lot of it comes down to how our brains work. We love the idea of rewards, even if the chances of getting them are super slim. Like, think about the lottery.
Okay.
Millions of people buy tickets, even though they know it's a long shot.
Yeah, it's like that hope springs eternal thing. Everyone
Yeah.
thinks they'll be the one to hit the jackpot.
Exactly. And options trading, with those big potential gains, it taps into that same hope. Plus, there's something exciting about actively trading, about feeling like you're in control.
I get that. It's way more exciting than just buying some index funds and waiting.
For sure. But even with the psychology, those success stories are still out there. Are those people just super lucky? Or does it take skill to trade options?
Yeah, is it all luck or...
There's definitely skill involved. The people who consistently win, they have a deep understanding of the market, they've mastered all these different strategies, and they're super disciplined. But even with all that, there's always risk.
So, like professional poker, you need the skills, but you also need some good cards.
Perfect analogy. And just like poker, most people at the table are going to lose.
Okay, so let's shift gears a little. Let's say someone is listening to this and thinking, all right, I get it, options are risky, but I still want to grow my money. What are some better alternatives that don't involve all that stress?
Great question. The good news is there are a lot of other ways to invest that make more sense for the average person. We've talked about index funds before, and those are a great place to start.
Yeah, index funds. Remind us why those are so good.
Remember that basket of apples? Instead of just buying one apple, imagine buying the whole basket with all the different types. That's kind of what an index fund is. It's a basket of stocks that tracks a specific market index, like the S&P 500.
Got it.
So instead of trying to pick the one winning apple, you're getting a little bit of everything.
I like that. Getting the whole orchard instead of just one apple.
Right. And that's the power of index funds. They're instantly diversified. Your money is spread across hundreds of companies, so you're not putting all your eggs in one basket.
And we all know what happens if you drop that basket.
Exactly. Even if a few companies in the index aren't doing well, the overall fund is likely to stay pretty stable.
That's really appealing, not having to worry about what one single company is doing.
Another good thing, index funds have really low fees compared to actively managed funds. So your money is actually going towards growth, not towards paying someone to manage it.
So we've got diversification, low costs, and they're pretty hands-off. What's the downside?
Honestly, not much. They're a great choice for people who want slow, steady growth over time. Now, if you want something with a little more flexibility, maybe more control over your investments, there are exchange-traded funds.
ETFs. I've heard of those, but I'm not really sure how they're different from index funds.
Think of ETFs like the cooler, younger sibling of index funds.
Okay.
They give you that instant diversification, but they're traded on stock exchanges, just like individual stocks.
So with ETFs, I can buy and sell them all day long, not just at the end of the day like index funds.
That's it. Plus, there are tons of different ETFs out there. Some focus on specific sectors like tech or healthcare. Others target specific regions of the world or even things like renewable energy or AI.
So if I really believe in electric cars, I could find an ETF that only invests in that sector.
Yep. They're great for customizing your investments, and since they're traded on exchanges, you can always see exactly what they're worth.
So we've got index funds for the set it and forget it folks, ETFs for the folks who want more control. Are there any other good options out there?
Of course. We can't forget about individual stocks. I know we talked about the risks of picking individual stocks, but owning a few carefully chosen ones can still be part of a good strategy.
Wait, didn't we just say picking individual stocks is risky?
It can be, especially if you're just chasing the latest hot stock or trying to time the market. But if you do your research, find companies that are fundamentally strong and have a good track record, individual stocks can be worthwhile.
So stock picking is more like a marathon than a sprint.
Yeah. It takes time and effort. You need to understand the company, its financials, its management, its competition.
Sounds like a lot of work.
It can be. But for some people, there's a lot of satisfaction that comes from owning part of a company they believe in.
Okay, so we've got a pretty good lineup here. Index funds, ETFs, and individual stocks. But it all still feels a bit overwhelming. How do we actually get started? Like, what's the first step to building an investment portfolio?
That's the million-dollar question, right? And it's probably simpler than you think.
Okay, welcome back. We've covered a lot of ground, and I'm feeling a lot more informed about the whole options thing.
Good. That's the goal.
But honestly, my head's still spinning a little. Like, where do we even begin if we want to start investing the right way?
It's a lot to take in, for sure. The financial world can seem really intimidating, but the good news is that taking that first step is easier than you might think.
Okay, I'm listening.
Yeah.
Lay it on me, no jargon, please.
Deal. First things first, you've got to define your financial goals.
Goals. Like, what am I saving for?
Exactly. A down payment on a house, early retirement, that dream trip you always talk about.
Oh, yeah. The trip is definitely on the list.
Having a clear goal will help you stay motivated to save. And it'll also help you figure out what kinds of investments make sense for you.
So it's like setting the destination on your GPS before you start driving.
Right.
Otherwise, you're just wandering around.
Exactly. Once you know where you're going, you can figure out how much you need to save, how long you have, and how much risk you're comfortable taking to get there.
Okay, goals first. Got it. But do I have to become a financial expert overnight?
No way. There are so many resources out there that can teach you the basics. Books, websites, podcasts, even financial advisors. Just find sources you trust.
So just like learning anything new, you don't need to be a master chef to start cooking.
Exactly. And the more you practice, the easier it gets.
All right, so we've got our goals, we're learning the ropes. What's next?
Next up is the R word, risk. You've got to figure out your risk tolerance.
Risk always makes me nervous, especially when it comes to my money.
I get it. But all investments come with some risk. The trick is to find an approach that matches your comfort level.
So it's not about avoiding risk completely. It's more about finding that balance where I'm not losing sleep at night.
You got it. Your risk tolerance depends on a lot of things. Your age, your goals, your timeline.
So someone in their 20s just starting out, they could probably handle more risk, right? They have more time to recover if things go south.
Exactly. They might be more willing to invest in things like growth stocks, whereas someone nearing retirement might want to play it safer, focus on preserving their capital.
Makes sense. It's all about where you are in life.
For sure. And it's something you should check in on every now and then because your situation might change.
Okay, so we've got our goals. We're figuring out the different investment options. We've thought about our risk tolerance. Now what? How do we actually start putting money into these things?
The easiest way is to open a brokerage account. Think of it like a bank account, but specifically for your investments.
So I can open one online and then buy stocks, ETFs, all that good stuff.
Yep. And a lot of online brokerages are commission-free these days.
Wait, zero commissions again? Is this like the options thing?
Nope, this time it's legit. Reputable online brokerages make money in other ways, so they don't need to charge you commissions.
Phew. Okay, good. So I've got my brokerage account. What's the first thing I buy?
Before you buy anything, remember the golden rule, diversification.
All right, don't put all your eggs in one basket. But how do you actually do that?
Think about asset allocation. That just means deciding how to split your money between different types of assets like stocks, bonds, real estate.
So like building a balanced meal. A little bit of everything.
Exactly. A good portfolio might have some U.S. stocks, some international stocks, some bonds for stability, maybe even a little real estate or commodities.
That seems like a lot to keep track of. Is there an easier way?
Absolutely. This is where those index funds and ETFs come in. Remember, they're already diversified. You buy one fund and you're instantly invested in hundreds of things.
So I don't need to spend hours researching individual stocks. I could just buy a few index funds and be done with it.
Pretty much. It's a super easy way to build a strong base for your portfolio.
This is starting to feel a lot more doable, but once I've got my portfolio set up, what then? Just kick back and relax.
Not quite. You'll want to review it regularly, make adjustments, and rebalance things as needed.
So more like a garden. You have to tend to it, keep it healthy.
Love that analogy. And just like your garden changes with the seasons, your portfolio should change as the market does, and as your own life changes.
This has been eye-opening. We went from feeling totally lost about options to feeling like we can actually start investing in a way that makes sense.
I'm glad to hear that. Remember, investing is a marathon, not a sprint.
Right. Slow and steady wins the race.
Exactly. Focus on your goals, diversify, be patient, and you'll be on your way to financial well-being.
And the biggest takeaway, just take that first step. Start small, keep learning, and it's never too late to invest in your future.
That's what we like to hear. Thanks for joining us on this deep dive.
And thanks for sticking with us. We'll catch you on the next one.